Most people are misreading XRP right now because while investors are focused on daily price action, a much bigger story is unfolding around regulation, institutional infrastructure, tokenization, and a financial system that processes roughly 3.7 quadrillion in annual transaction value. In the next 20 minutes, you'll see what analysts are watching: the DTCC, the Crypto Clarity Act, SBI's XRP initiatives, and the growing role of XRP and XLM in the conversation about the future of financial settlement. Start with the scale. Not millions, not billions, not even trillions. Quadrillions. That's the number at the center of today's discussion, ladies and gentlemen. The DTCC sits behind much of the settlement infrastructure that powers U.S. capital markets. According to widely cited figures, it processes approximately 3.7 quadrillion in annual transaction value. Most people have never heard of it. Yet without it, modern financial markets would struggle to function. And today's conversations around tokenization, digital assets, interoperability, and next-generation settlement systems are increasingly intersecting with discussions involving XRP and Stellar Lumens. But here's where it gets interesting. The real story isn't about price. The real story is about structure. Short-term noise, long-term structure. Price is reacting, systems evolving, I always say. Those two things are not always the same. Institutional investors don't move because of excitement. They move because of clarity. For years, regulatory uncertainty limited participation in the digital asset sector. Technology existed, interest existed, capital existed, but the legal certainty did not. This is why many observers are paying close attention to the Crypto Clarity Act. Supporters believe it could provide a clear framework for digital assets, blockchain developers, and market participants. The significance goes beyond crypto. Clearer rules reduce uncertainty. Reduce uncertainty lowers risk. Lower risk can increase participation. And increased participation can unlock capital that previously remained on the sidelines. Now, this is what most people miss. The biggest institutional barrier has never been technology. It has been compliance. When compliance becomes easier, adoption can accelerate. Quick disclaimer, this content is for informational, educational, and entertainment purposes only. It's not financial advice. Always do your own research. With that being said, let's continue. The regulatory story is only half of the equation. The second half is macroeconomics. Markets run on liquidity. When liquidity tightens, risk assets struggle. When liquidity expands, risk assets often perform better. Recently, investors have been watching several developments: energy prices, inflation trends, interest rate expectations, potential changes in Federal Reserve policy. Why? Because lower inflation pressures may create more flexibility for policymakers. More flexibility can influence borrowing costs. Borrowing costs influence capital flows, and capital flows influence markets. Crypto does not exist outside the global financial system. Write that down. It exists within it. That is why macro conditions matter. And when regulatory developments and macro trends align, the effect can be more powerful than either catalyst alone. History, ladies and gentlemen, provides an important lesson. I want to talk about the Medici banking network. See, during the Renaissance, the Medici family transformed European finance by improving how money moved across regions. They did not create value from nothing. They improved infrastructure. By reducing friction, they enabled more commerce. More commerce created more opportunity. More opportunity created more growth. The lesson remains relevant today. See, financial systems become valuable when they reduce friction. Supporters of blockchain technology argue that digital settlement networks could accomplish something similar for modern finance. A different technology, same principle. Reduce inefficiency, increase connectivity, expand participation. If you're enjoying breakdowns like this, make sure to like and subscribe to the channel. Share with someone you think doesn't understand what's going on. It helps the channel out a lot. Now, with that said, let's continue because the next part is where it gets even more important and spicy. I want to go back to the DTCC. Why does everyone keep talking about it, you might ask? Because the scale is difficult to comprehend. A system handling trillions would already be enormous. A system handling quadrillions? Well, that enters a different category altogether, a different realm. See, as tokenization develops, institutions are increasingly exploring ways to represent traditional assets digitally. Stocks, bonds, funds, real-world assets. Everything becomes easier to move, transfer, settle, and manage when represented digitally. But digital assets require digital infrastructure, and that infrastructure must communicate across networks. Let that sink in. This is where supporters see potential roles for XRP, the Anointed One, and XLM, not necessarily as replacements, but as bridges, liquidity layers, settlement tools, interoperability mechanisms. But the real shift came when institutions started asking particular questions instead of theoretical ones. How do we settle efficiently? How do we move value globally? How do we connect systems? Those questions matter more than hype. Let's discuss velocity. Velocity refers to how frequently a token is used within a given period. Higher velocity means the same asset can support more activity. Lower velocity means larger liquidity pools may be required. This concept appears frequently in valuation models involving XRP and XLM. Some analysts have examined what happens if a small percentage of settlement activity eventually flows through these networks. 1% of DTCC volume equals approximately $37 trillion. Let that sink in. You should write that down. From there, analysts apply different assumptions regarding velocity and circulating supply. The results can produce dramatically higher theoretical valuations than current market prices. But an important distinction must be made. These are models, not guarantees. They represent possible outcomes under specific assumptions. Investors should treat them as a framework rather than predictions. According to commonly discussed scenarios, XRP could theoretically require trillions in market capitalization if it were supporting large volumes of settlement activity. Under certain assumptions, valuation models have generated figures around $60 per token. Other assumptions generate significantly larger numbers. The same is true for XLM. Because XLM has a smaller circulating supply, some models generate even higher per token values. Again, these calculations are dependent on adoption assumptions, velocity assumptions, and usage assumptions. Nothing is guaranteed. The only thing guaranteed in life is death and taxes, ladies and gentlemen. Write that down. But the exercise accelerates a key point. Utility matters. Networks derive value from activity. The more economic activity a network supports, the more important it can become. The creation of SWIFT. You see, before SWIFT, international banking communication was fragmented. Processes were slower. Coordination was more difficult. SWIFT created a standardized network that institutions could trust. As participation increased, the network became increasingly important. Its value came from adoption, not speculation. Adoption. Many blockchain advocates believe the future may involve similar network effects, not necessarily replacing existing systems, but integrating with them. See, the lesson from history is simple. Infrastructure compounds, and infrastructure becomes strong as participation grows. Real-world adoption signals already exist, ladies and gentlemen. One frequently discussed is SBI's XRP-related initiatives in Japan. What makes this significant is not the size of any single pilot. It's the signal. Large financial institutions move carefully. They test, they evaluate, they measure risk. When traditional financial institutions explore digital asset integration per markets, they pay attention. Because adoption often begins gradually before becoming obvious. One experiment, one partnership, one use case, one integration, then another, and another. See, technology also matters. One ongoing debate involves permission networks versus open networks. Supporters of open systems argue that transparency, interoperability, and composability provide important advantages. Supporters of permission systems emphasize privacy and control. This debate continues across the industry. Advocates of XRP and Stellar argue that open interoperability systems are better suited for large-scale connectivity across institutions and markets. See, whether the view ultimately proves correct remains to be seen, but it remains a central part of the investment thesis. I want you to think about the Roman roads. The roads themselves were not the final product. They enabled trade, communication, logistics, growth. Digital settlement infrastructure may serve a similar role. The value is not necessarily the road. The value is what moves across it. See, if you consider the early internet, many people focused on individual websites. Few focused on the protocols underneath. Yet those foundational protocols became essential to the modern digital economy. Some analysts believe blockchain infrastructure could follow a similar path. The most important systems may ultimately be the ones operating behind the scenes. Another factor attracting attention, ladies and gentlemen, is quantum security. As computing power evolves, blockchain systems must adapt. Many networks may require significant migration processes to maintain future security standards. Supporters of Stellar often point to architectural advantages related to future upgrades and key management. The argument is not that quantum threats are immediate. The argument is that institutions planning decades ahead must now consider them now. Long-term infrastructure requires long-term thinking, and that is exactly how large financial institutions operate. Because when we step back, a larger pattern becomes visible. Several independent developments are occurring simultaneously. Regulatory discussions are advancing. Institutional experimentation is increasing. Tokenization is expanding. Macro conditions are evolving. Infrastructure conversions are accelerating. Individually, each development matters. Collectively, they become far more significant. This convergence is why many analysts describe the current period as a potential inflection point. Not because outcomes are guaranteed, but because multiple structural trends are moving in the same direction. A few years ago, the environment looked very different. Regulatory uncertainty dominated headlines. Institutional participation remained limited. Digital asset adoption was largely speculative. Today, the conversation is broader. Major institutions discuss tokenization. Governments discuss frameworks. Market infrastructure discusses modernization. And financial firms increasingly explore blockchain integration. That does not guarantee success for any specific project, but it does demonstrate how far the industry has progressed. Investors should separate speculation from adoption. Speculation can drive prices temporarily. Adoption creates a lasting structure. The distinction is critical. A network can experience excitement without utility. A network can also build utility before markets fully recognize it. The most important question is not whether people are talking about a system. The most important question is whether people are using it. See, usage creates demand. Demand creates relevance. Relevance creates staying power. So what's the ultimate takeaway, you're asking, ladies and gentlemen? XRP and XLM story is no longer just about cryptocurrencies. It's increasingly connected to larger discussions involving settlement tokenization, interoperability, regulation, and financial infrastructure. While these networks become central components of future global finance, nobody knows. Will institutional adoption continue expanding? Many investors are watching closely. What we do know is that financial history repeatedly rewards those who understand structural change before it becomes obvious. Short-term noise, long-term structure. Prices reacting, systems evolving, I always say. And if the coming years bring greater regulatory clarity, broader institutional participation, and deeper integration of digital infrastructure, the implications could extend far beyond any single market cycle. If you enjoyed this analysis, subscribe, like the video, share your thoughts below. Because the biggest stories in finance are rarely about headlines. They're about the systems operating underneath them. I always tell you, ladies and gentlemen, pay attention to what's quiet. I hope everyone's having a great weekend. We've got big news going on in the markets. A couple things I want to touch upon. I want to welcome all the new members of the Patreon, all the new members of the membership channel. Ladies and gentlemen, will there be peace, or we will continue to have death by a million tweets, headlines? I don't know. If you're looking to learn how to invest, if you're looking to learn how to trade, so you really got to ask yourself, do you want to learn how to invest? Do you want to learn how to trade? If so, doesn't matter if you have experience or you're seasoned, come and join the Crypto Public Desk Monthly. Join over 580 active traders and investors who are taking advantage of the financial chaos and learning the lessons and the tricks that we learned on the floor of the New York Mercantile Exchange. One good tip from the pits can pay for your entire year subscription, ladies and gentlemen. And AI can't take away trading. That's one thing I got to say about that, because we get phone calls every day that people want to train AIs on what we do, and we just won't do that. I got a big question I want to ask everybody here because everyone's been asking me, and I just got back from visiting some new clients, older clients, and new clients that were recommended to us that we first met. The Strait. What if the Strait never fully reopens? See, a peace deal not necessarily the same as Hormuz opening. Okay, the market appears to treat the reported U.S.-Iran memorandum of its an understanding as more of a lesser done deal, in my opinion. See, with Brent giving up nearly 20 billion barrels since mid-May, I think that there's two distinct questions: whether some form of agreement is really reached and whether that agreement restores flows to anything approaching pre-conflict levels. That's the most important thing to be paying attention to. The distinction really matters, ladies and gentlemen, because if you consider for the medium-term price formation, it's really not clear whether an agreement to end hostilities will also lead to the dismantle of the framework Iran has built around the Strait in the past few months. That's really important. See, a lot of people are getting cut up like sushi right now and being carried out in body bags of this market. You look on Iran said on May 5th, they launched the Persian Gulf Strait Authority to assess sovereign management of the waterway and formalize its creation on May 18th. I don't even know what that is. The body was set up to codify Iranian control as a permanent feature rather than a temporary crisis measure. So it's like you got two sides sending out tweets into the ether that nobody believes. And it's crazy. I mean, it really, really is crazy. I mean, this is what's moving the market. And it's how crazy each side and what they say really influences the market, right? But on May 28th, the U.S. Treasury, OFAC, imposed sanctions on the Persian Gulf Strait Authority. It later clarified that striking deals with Iran to ensure safe passage of the strait is not allowed, even if no payment is made. Again, so there's signs that this state of play may be increasingly accepted by the industry, including Western ship owners. So OECD, Asia importers, and flagship national oil companies. In the first 2 months of the disruption, the majority, greater than 70% of Hormuz traffic was made up of Iranian-linked cargoes, with the remaining tankers carrying non-Iranian oil destined to Asia, countries including like China, India, Pakistan, Bangladesh, Thailand, Vietnam, and the Philippines. But in May, tankers carrying oil from Aramco and ADNOC, the region's two biggest NOCs, well, they sailed through the strait. You had two Japan-bound VLCCs. They successfully navigated the strait on the 14th. South Korean tankers passed through Hormuz under the coordination with Iran. So the first since the strait of the conflict, And this is really affecting Korea, Asia. I mean, you had one Greek shipping company, they stated that they would rather pay a fee to transit the strait if it helped facilitate the traffic. So it's not clear if all these moves by Western aligned ship owners and flagships and NOCs involve the coordination with Iran's PGSA. But if you got to see, we look at Lloyd's. I look at Lloyd's, what they're reporting. You got around 300 non-Iranian vessels have been in contact with the PGSA since its creation. Okay? That's Lloyd's list in June 2nd. So if you look at these moves, they're not fully aligned with the respective government's stated position that the strait should reopen unconditionally without any toll or toll fee-based transit. Ladies and gentlemen, this is what I am paying attention to. This is what I'm conveying to anyone who attains any capacity. It's not financial advice. As financial mercenaries, right? And when we learn to take advantage of this, see, I set the table here. I tell you how we identify scenarios inside the Crypto Public Desk Monthly, our Patreon. We show you how we're going to take advantage of those scenarios. What price points, what assets, financial instruments, time horizons, what currencies we're using them in as well. But this is how people will get chopped up like sushi. And it's knowing what piece of information, what to look at and find that's the difference. You have to look at the financial markets like the dry season, the Serengeti, when the water it shrinks down the pools. You have a lot of fish. They become carnivorous. There's not enough auctions left. So they eat each other. And only the strong survive. This is the biggest thing that we're paying attention to. That is why we are the wolf pack. Remember, the wolf isn't the most mighty animal in the jungle, but you don't see it doing tricks in the circus. Remember that. Okay? So that's the main difference. So I'm keying off of this to pay attention to where we're going and why. That tidbit, right? And again, that's very important. So we're supposed to see some signing going over the weekend. Does it happen? Does someone pay attention? Not. But what I think from my own standpoint, what you have is you have two groups, both having a Twitter battle, sending out messages into the ether. Who knows if it's true? Who knows if it's not? But Paying it. I remember when I first started trading oil and the people that taught me in the floor, they paid for satellite photographs of floating storage roofs in the holdings so they could tell and try to tell how much oil was in these storage facilities. The arc of the shadow we tried to disseminate how much oil was in there. That's one big thing. But I want you to understand something. This is going to dictate where it's going. And this is why family offices retain us. It's for these crazy pieces of information that we know and implement and how that no one else does. And it works. I always tell you, we're not crypto influencers. I'm a financial mercenary. We're capping the Patreon very, very soon because once our Zoom calls start, I'm going to be starting in the next day or so for the Crypto Public Test monthly members. We can't service everybody. It's too big now. I love it because I love giving back. You make a living by what you make, a life by what you give to other people. But we just can't service everyone anymore. And it's fantastic. I love the whole group. But understand, as we teach the tricks that I was taught on the floor of the Mercantile Exchange since only 15 years old, it's like knowing where to look for water in the desert. You have to understand something. I said this in a previous video. Most people have the memory of a goldfish in the market. The goldfish forgets one side of the bowl as it swims to the other. So when you look at what's happening, and I'm going to say this again, XRP, ICP, HBAR, if you like XLM, I get it, right? It's all part of a broader based thing. But these are things, and this is not financial advice, you really don't want to miss out on. Again, because when Operation Print It to Win It begins, and oil is going to keep falling, and there's things I will not give away for free right here, but I tell you enough of it is. And if you're writing things down, like I told you, we were bearish on metals for a very long time. If you were following this, I salute you. You did very well. We're bullish long term. I'm buying physicals right here. Silver, gold, sacking it away. Buying XRP, ICP, HBAR, baby. Ladies and gentlemen, one day ICP is going to take off, but it's not going to look back. It's nothing to do with the rest of the plays that we are in the crypto market. This is not financial advice, my opinion. It will take off one day and not look back. The same way when XRP one day has its repricing movement, and I'm not going to go over this right here, right now. I had a long talk with a lot of family offices about my feelings about XRP. I went very, very involved into this and why. Again, I bought my first house from the carry trade. I only talk about things that I understand how it affects me, what I've lived and not lived. But when this time period's over and it's coming to an end, people will look back and say, I wish I got as much as I could. See, ladies and gentlemen, gold is falling not because geopolitical risk disappeared, but because higher energy prices are increasing expectations for tighter monetary policy. The market's focused on oil and interest rates, not military headlines. Headline inflation is accelerating, but core inflation remains relatively contained. Rate expectations are becoming the dominant driver of precious metals. Again, the gold-silver ratio near 64 suggests silver has weakened substantially relative to gold. So June 17th Federal Reserve meeting may be more important to guidance than for the actual decision. What I'm watching, and this is what I'm watching, Brent crude oil and developments around the Strait, Federal Reserve language regarding inflation persistence, changes to future rate projections and policy guidelines, real yields and U.S. dollar strength, the gold-silver ratio and whether silver begins outperforming, signs that supply shock inflation spreading into broader categories. Now, why I think this is important? Because markets are entering a period where inflation, energy, geopolitics, and monetary policy are colliding at the same time. Most investors are focusing on headlines. I tell you all the time, pay attention to what's quiet. You got to pay attention to what's quiet. I'm not an AI person. I edit videos. The larger opportunity comes from understanding the chain reaction underneath those headlines. See, if oil continues driving inflation, central banks may remain restrictive longer than expected. If central banks remain restrictive, precious metals could face additional pressure. But if inflation stabilizes, ladies and gentlemen, while rate expectations remain elevated, markets may be setting up for a significant repricing event. Understanding these relationships is how investors move from reacting to news to anticipating what comes next. Ladies and gentlemen, if you want to learn how to trade, if you would like to learn how to invest, if you want to learn how to take advantage of everything I'm talking about in this time period, do come and join the Crypto Public Desk monthly inside of our Patreon. One good tip from the pits can pay for your entire year subscription. To come and join over 580 active traders, investors who want the deeper macro research and they're taking their own destiny into their own hands, ladies and gentlemen. Have a blessed weekend. I love you all. Don't get caught up like sushi. This content is for informational, entertainment purposes only. Should not be taken as financial advice. Never invest based solely on a YouTube video. Always do your own research. I keep telling you, pay attention to what's quiet, ladies and gentlemen. That's the most important thing right now, because the world is going to change. The themes that we're looking at, if you make it to the end, you got to the Italian ice. I'm going to start answering questions again because I got the time to do it again. I love everyone's questions. I love everyone's energy. I love the energy inside of the private chat, inside of the Patreon, Crypto Public this month. That I love. I love that so many people now are starting to come out of their shells and talk more and more and more, which is fantastic. You make a living by what you make, a life by what you get to other people. But with that being said, ladies and gentlemen, don't get cut up like sushi. Don't FOMO this. Follow your plan. If you're looking to someone hold your hand in mentorship and guidance, come and join us, because this is what a time to be alive and what a magnificent thing. We're following also the screwworm that's getting worse now. We've been following that for quite some time when on our parasitic plays and weather plays and our soft commodity play. We got that on the radar board now. With that being said, ladies and gentlemen, I love you all. I'll see you on the front lines.